Hello, today we'll be talking about how to estimate quarterly tax payments. My name is Daniel Passon with Robert Hall & Associates. I'm one of the consultants here, and hopefully you can like, subscribe, and let that notification bell ring when we have future videos that you can be notified of. Now, today we'll be talking about how to estimate quarterly tax payments. First off, we'll be discussing what are quarterly tax payments. Next, we'll be discussing how to make them. And third, we'll be discussing what is it, what do you need to pay, or how should you figure things out if your year changes a lot? Because maybe those quarterlies are based on incorrect information. Now, quarterlies. We're discussing individual quarterlies today. We're not discussing payroll taxes, which could be paid quarterly. We're not discussing quarterlies on a business. We're not discussing sales tax quarterlies. We were talking about individual quarterlies. Now, there's lots of different quarterlies out there, but today you found the individual one. So calculating quarterly payments on an individual tax return. Quarterlies are based for a couple reasons. Mainly they're there for reducing or avoiding an underpayment penalty. I like to discuss with my clients though and say that quarterlies can be also there just to general budget your money better and make sure you're not putting yourself into a bad situation. Because as an example, maybe you have no requirement to pay quarterlies, but you know you're gonna owe about $10,000. Even though $10,000 in one lump sum or $2,500 a quarter are the same numbers, it can feel a lot better and a lot easier to pay $2,500 a quarter. So as much as quarterlies are there for underpayment penalty reduction / avoidance of that penalty, you might want to do it just for general budgeting reasons too. But let's discuss estimated tax payments and how they're calculated. In order to avoid a penalty, you need to pay either 90% of your current year's tax liability or 100% of your previous year's tax liability if your income is under $150,000, or 110% of your previous year's tax liability if your income is over $150,000. Now, 90% of the current year's tax, that's a little harder to determine because we don't know what this year's taxes are going to be. And this is on the total tax, not on the refund or the bill you owe. So if you have a refund, you might still have a requirement because this is based on the tax, not your refund or what you owe. Or 100% of your previous year's tax if your income's under $100,000, or 110% of your previous year's tax if your income's over $150,000. That is the number that you will base your quarterlies on based on a computer, because that is the number that is known. Because you've assumingly done your previous year's taxes, so you know what 100% of last year's numbers are. So 100% of your previous year's tax or 90% of your current year's tax. Now, when you're talking about this, those are to avoid an underpayment penalty. So they will be potentially a lot more than you used to if you're at $110,000 or $150,000 or more and you're paying 110%, because now you are effectively overpaying your taxes based on the current year. But these are there because let's just say if your income doubles, triples, quadruples, goes way up, the 100% or the 110% number still is in effect to lower that underpayment penalty. Now, once again, you might still owe a lot of money if your income goes way up, but that penalty for not paying enough in during the year would be potentially zero or much lower. Typically zero if you're effectively paying your quarterlies, but they are time-stamped. So let's talk about how to pay those quarterlies. Now, quarterlies are due April 15th for the first quarter, June 15th for the second quarter, September 15th for the third quarter, and January 15th for the fourth quarter. Oftentimes it's advised to pay by December 31st for deduction reasons if you're potentially on a calendar year basis, but they are due by January 15th. Now, those quarterlies you pay with on the individual return, 1040 ES, or on the state side, if you're in California, the 540 ES. Now, the state, if we're talking about California, if you're in California, if you didn't know, California is a money-hungry state. They're broke all the time, but they obviously charge us a lot to be here, but still, they want their money up front. And I say that because for the state, you have your first quarter still due April 15th, second quarter due June 15th, but they skip the third quarter and they have a fourth quarter due by January 15th as well. The thing about them is they are not quarterly. That's why they skip the third quarter. They want 30% in the first quarter, 40% in the second quarter, and then the other 30% in the fourth quarter, because they want 70% of their money in the first half of the year. Talking about quarterlies a little bit more for California, if your income is over $1 million, they do want the not 100% of the current year's tax. So California is a little greedy in that way too, because you do need to pay them up front if your income is over $1 million. So touching that on the first part and the second part here. Those are how you make the payments, the 540ES and the 1040ES. If your income is enough to where you have over $80,000 in total tax or $20,000 in total payments, each payment to California, you do need to make sure you pay those 540ESs directly online though, electronically, because if you do pay them with a voucher, they will charge you. But you pay them with the 540ES for the state and the 1040ES for the federal. Now, let's just say that's all fine and dandy, but your income is going to go way up or way down. Kind of back to the first part, 90% of the current year's tax or 100% of the last year's tax if your income is under $150,000. That is what you need to pay to avoid a penalty. This is all about the penalty. So we'll focus, if your income goes way up or way down, on the budgeting part of this. Now, to avoid a penalty, if your income drops, obviously if you pay 100% of last year's tax, you've overpaid. There won't be any penalty, but now you're gonna have a big refund. That's where if you have your income does go down and you want to pay less, you potentially could. You might be penalized, but at the same time, it's the lesser of evils. Do you want to have a refund or do you want to potentially have a small penalty? And I say small because in the grand scheme of how the IRS charges penalties, it is not a huge penalty, but it is there. Regarding that version, I would say to reach out to us and have someone potentially have a consultation or go over the numbers, because maybe if it is that scenario where you don't want to overpay, but you don't want to not pay enough, you'd want to have a consultation to go over those numbers. Now, if your income goes way up, same thing goes. Do you want to budget and pay more than you need to? Because if you're paying 100% of last year's tax and your income is going way up and you're only paying 100% of last year's numbers, but you have a big tax deficiency, do you want to knowingly overpay and pay more to make sure that you're budgeting for yourself? That is up to you, because the penalty, the underpayment penalty, was only as long as you pay 100% of last year's tax. Now, I would same thing in this scenario. I would recommend reaching out. You can have a consultation and go over that number, because maybe you want to budget, because if the money's in your account, you'll spend it. But those are the two scenarios for ups or downs. You might want to pay more, pay less, talk to an advisor, and that would be your best route to go. Today, we talked about how to estimate tax payments are calculated, what are they, and how to make those like the calculations of when you need to pay them or not. Hopefully this all made sense, and hopefully we've given you more guidance on what they mean to you. And you've reached out to our office at Robert Hall & Associates, and feel free to like, subscribe, and click on the link below to find out more information. But our office is here to assist you with these, as estimated taxes can be a bit confusing because some of it's based on the information we don't know, 90% of the current year's tax or 100% of last year's tax, which maybe your situation did change. So reach out to our office if you want to further know more information about this, and we'll be here if you need our assistance. Thank you.